Now, it has been a bad week for the U.S. economy. New jobs numbers revealed today showed that we had the worst private sector job growth in 8 months in the U.S. It knocked the unemployment rate up from 9% to 9.1%. Earlier this week, a distressing housing report has economists saying the residential real estate market has double-dipped, the U.S. debt ceiling has not been raised, and Moody's issued a warning on the country's credit rating as a result. And President Obama today, in the face of a dismal jobs report, gave a speech at a Chrysler plant to celebrate the resurgence of the auto industry, saying, you know, in the economy, there are bumps to the road to recovery. But is it time for a major rethinking of the U.S. economy in the wake of all of this bad news? Joining me is Peter Schiff, president of Euro-Pacific Capital, to talk about it. Peter, excuse me. Thanks so much for being with us. First of all, I want to take a look. You know, we always hear these jobs numbers reports. They're better this month. They're worse this month. But I want to look at this chart, and I hope that they printed it out for you. If we could put it up, the unemployment chart. So there are a lot of numbers in this chart, but really the biggest takeaway is that that red line is the unemployment in the recession that we're in compared to all the other recessions in this country's history. And it is way worse when it comes to joblessness. So my question for you is, you know, is this a blip on the radar, or is this, you know, a really dire situation that something really major needs to be done about?
It's dire. The reason that that chart looks as bad as it is because we're not in a recession this time. We're in a depression. You know, unfortunately, we didn't lose enough jobs last month because President Obama still has his. And, you know, he thinks we're on the road to recovery. No, he's put us on the road to ruin. You know, he's there, you know, bragging about how the government saved the auto industry. They put the final nails in the coffin of the auto industry. We would have a much better auto industry if we had allowed them to go through a legitimate restructuring through bankruptcy. Instead, all we did is turn the keys over to the auto industry, to the UAW. And now we're going to have a less competitive auto industry than would have been the case had we allowed the market to do it. But, you know, the data that we've been getting for the last several weeks, and of course today's data, you know, merely solidifies that with the weak jobs numbers, is that the effects of trillions in government stimulus are wearing off. And the biggest, or the mother of all hangovers, is now setting in. And the Fed is in a very difficult dilemma here because the economy is already relapsing into recession, and they haven't even started tightening yet.
Now, my question then is, because the Obama administration seems to think that, you know, this is a blip, but we're going down the path to recovery. But is it time for a major rethinking? What about, for example, letting China invest? China wants to invest. Sweden, for example, saw first quarter growth of 6.4% this year. And some of their big companies, you know, Volvo's now in the hands of the Chinese. Reports say a Chinese company came to the rescue of Saab. Would letting China invest in the U.S. help?
Well, they're already investing heavily. Unfortunately for the Chinese, they're investing in the wrong areas. They're buying U.S. government bonds, which is not helping us or the Chinese because it's helping to grow our government. I think that, you know, we do need to allow capital to flow freely, but what we have to do is stop borrowing all this money. You mentioned earlier that one of the problems is that we haven't raised the debt ceiling. That's one of the only good things out there, that ceiling is still there. Unfortunately, they're going to raise it. We're going to go deeper into debt, which means bigger problems. And this is not, you know, the economists are describing this as a soft patch. It's not, it's quicksand. And the economists who think this is a soft patch, these are the same people who in 2007 said the U.S. economy had never been in better shape. They didn't see this crisis coming.
Right.
They've never understood the problems with the U.S. economy, and they still don't understand them. They think that government stimulus made the problems better. It didn't. It allowed the problems to get worse.
Well, I want to ask you, you know, you said China is investing in the wrong place. They're investing in dollars. China wants to use those dollars to buy U.S. companies. I want to play you a little something from, if we have that soundbite from Michael Hudson, he's an economist, what he had to say about why they're not able to invest in U.S. companies.
They wanted to reciprocate and buy U.S. companies, just as the U.S. wanted to buy China. The U.S. says, we will not let you buy filling stations here or refineries. You can't buy in America. We can buy in you. You can't buy in America. You have foreign takeovers all the time of U.S. companies, but they're European takeovers, or they're takeovers by friendlies. So obviously, America views China as a potential enemy.
Is this why the United States doesn't let China invest? And are they doing it, you know, cutting off their nose to spite their face?
Well, I think so. But what's really going on is the U.S. government wants China buying treasuries. They don't want them buying real assets instead.
Do you think that's why?
China's our biggest lender.
Do you think that's why the United States? Do you think that's why the United States doesn't let China buy U.S. companies? Because they need them to buy U.S. dollars.
Absolutely. Plus, they know as long as they're buying our debt, we can always default. We can always print money and wipe it out with inflation. We don't want the Chinese to get their hands on our real assets. But the minute the Chinese figure out that, this is a just big a Ponzi scheme that they're participating in, that they can never actually use those dollars for the things that they want, all they have to do is endlessly loan them back to us at ridiculously low rates of interest. They're not going to want to play this game anymore, and they're going to walk away, and so will the rest of the world, and then we're going to be stuck with a pile of our own worthless currency and nothing to buy with it.
Speaking of currency, corporations have a lot of it. Where are they putting it? Because you mentioned the Fed's policy of quantitative easing, all of the liquidity in the system, but interest rates in the United States have never been lower. There's no, essentially, return on investment in the U.S. if you're going to put that money to work here. So is that all going overseas?
The smart money is. Some people are still chasing yield by going, longer on the curve and buying, 10-year, 20 years. I think they're going to get destroyed as interest rates ultimately catapult higher. But the smart money is going into gold. Look at the Dow gold ratio is the lowest it's been, I think, of the entire cycle. It's around 8-to-1 right now. So money is moving into gold. It's moving into commodities. Despite this correction in stocks, oil is still over $100 a barrel today on the close here in New York. Smart money is going offshore. It's going into foreign stocks, foreign currencies. Look at the Swiss franc. The dollar closed today at an all-time record low against the Swiss franc. That's the safe haven currency, not the U.S. dollar.
So then how does the United States government get corporations to invest any of that money here at home in the United States? They're certainly not getting it from corporate taxes. I want to bring up a chart showing what some of the largest companies in the U.S. have paid in corporate taxes, and they've paid zero or had a negative tax rate. I mean, that doesn't seem fair, needless to say, but that money isn't coming into the U.S. government, despite the fact that these companies are making such huge profits. There's a lot of talk about closing loopholes in tax policy, even lowering the corporate tax rate. Would any of that help?
Well, it would help to abolish the corporate income tax entirely, because then corporations wouldn't waste so much of their resources figuring out how to avoid taxes. Instead, they would use their resources to generate more profits, more economic growth, and more jobs. Corporations don't really pay taxes. Their shareholders do. We're already taxing them when they get their dividends. The employees of corporations pay taxes when they get their paycheck. So let's tax the employees and the shareholders. Don't tax the corporate level. It's just a political smokescreen. But if we want corporations or businesses to work harder, invest more, we need to remove the barriers, such as high taxes, all these regulations, all these mandates, all the legal liability. The U.S. government makes it very expensive and very dangerous for companies to hire people. So why should they?
Well, but Peter, at the same time, companies are getting out of paying these taxes, and there has been a lot of money flushed into the system that was supposed to get companies to loan money to people, loan money to businesses, hire people, and that hasn't happened. They're hoarding cash. Corporations are sitting on cash. So what is going to end that? What makes you think that more deregulation or lower taxes is going to stop that?
Well, because in order to lend money, they have to be able to pay it back. So there has to be a climate where businesses can succeed and flourish, and they can't. With all the taxes and all the regulation, they're not going to do it. And would you want businesses to lend more money to consumers? Consumers are broke. They can't pay back what they've already borrowed. Americans are drowning in mortgage debt, in credit card debt, in student loans, and auto loans. But small businesses can't get money. Small businesses can't get money, and small businesses can't get money, and that's supposed to be one of the bedrocks of, the United States economy. But of course.
Sorry.
The U.S. government is borrowing $1.5 trillion a year. There's nothing left for business. And not only the U.S. government is what it's directly borrowing, the U.S. government is guaranteeing all the mortgages, all the student loans. There's no money left. Businesses are starving for capital because it's all going to Washington.
But at the same time, I mean, the government bailed out a lot of those mortgage-backed securities because that's what investors all over the world held. They were essentially reinforcing the major investments that countries like China and Russia had made.
Right. But where did the money come from to bail out those investors who should have lost money? It was taken out of our pool of capital, so that money is not there for businesses. And even if it was there, would they really want to take the risk of borrowing it and have to pay it back when the climate is so hostile? Taxes are high and going higher. Regulations are numerous, and there's more of them in the pipeline. The legal exposure is increasing. I mean, who's going to want to invest in an economy that the government is deliberately destroying?
Here's what I don't get, though, Peter. Corporations have had record profits at the same time that millions of Americans have lost their jobs and become more productive. So I don't understand how can you balance what you're saying, which is that this is a hostile environment for corporations in which they can't profit, with the fact that corporations have seen record profits and CEO pay has gone through the roof.
Well, I will agree that pay is going up, but that's not a good thing. And when you're looking at record corporate profits, it's being skewed by major companies that are making money speculating because of low interest rates. These companies are making money, from borrowing and lending and all the stimulus. But beneath the surface, if you look at a lot of the smaller companies, they're struggling. They don't have record profits. They have losses. They're barely getting by. This is a phony economic recovery that it's basically a giant hallucination caused by the government stimulus, which is like a hallucinogen, and we think the economy is getting better. All we're doing is borrowing and spending money. We're borrowing money that we should be saving. We're spending money that we should be investing, and we're counting as if this is a real recovery. That's why you're seeing the economic data imploding the way it is, because it wasn't real.
Speaking of spending, we have a debt ceiling that has not been raised, and that's what the U.S. government is going to need to do if they want to continue spending the money that they've committed. We've seen Moody's issue a credit warning this week over the U.S. debt ceiling disagreements. As someone who ran for Congress, do you think that there will be an agreement on debt reduction with lawmakers that they're trying to negotiate? Do you think that this Moody's warning will light a fire under their, butts to raise the debt ceiling quicker, sooner than later, and to reassure international investors that they'll do what they need to in order to spend the money they've committed?
Unfortunately, it's our money they're spending, and although a lot of it is just being printed by the Fed, but unfortunately they will raise the debt ceiling. They do not have the political courage to do the right thing and not raise the debt ceiling and force Congress to cut spending. We cannot keep all the promises that have been made. Congress needs to level with the American public about that and start making the cuts. But given the renewed weakness in the economy, given the down move in the stock market, I'm sure that the politicians are going to come together and decide that we need to continue the artificial stimulus, that we can't cut back on government spending. They are going to do the wrong thing. What's dangerous is not failing to raise the debt ceiling, but raising it and continuing down the path that we're on. The only solution is to slam on the brakes. We're heading off the edge of a cliff, and Congress, if they take off the debt ceiling or raise the debt ceiling, that's the equivalent of stepping on the gas. We don't need more gas. We need to slam on the brakes.
Just yes or no question, because we're out of time, but slamming on the brakes, wouldn't that mean derailing the entire global financial system?
Derailing it, it's going over the edge of a cliff. We got to derail it. We can't build a real economy until we allow this phony one to implode. The thing is, at least we can drive the economy into a ditch, which is better than letting it go off the cliff, and then we can start repairing it or allowing the free market to repair it, because right now we're headed for a huge disaster.
All right, so you think the Obama administration should break some more promises to the global financial system. They certainly seem to have broken some for the American people when it comes to the economy and those bad numbers that we were just looking at.
Not sure which promise you're referring to, but he's certainly broken any promises he made to get the economy going or to get the government out of the way.
All right, Peter, we're out of time. I want to thank you so much for being on the show today. He's president of Euro-Pacific Capital.